All trading videos by OFA are for educational purposes only to illustrate sample use cases of the software functionality. OFA is not a trading system or strategy being marketed on a performance track record of live or hypothetical results. Trading involves substantial risk. Please do not purchase or subscribe to OFA services without carefully reading the complete required disclaimers and terms and conditions located on the OFA website. In this lesson, we're going to be discussing trend following strategies with the OFA toolset. We are looking at the euro from January 18th, about 8:15 in the morning. What I want you to notice on the chart is that early in the morning, about 2 a.m., so the London Open, we make a high. The market trades lower, has a breakdown, starts to consolidate, makes a little bit lower low, and continues consolidating sideways. Now I can visibly see that there is some consolidation here and not a trend off of the low just using the OFA tools. So if I go and grab a range profile and put it on the low and follow this up, I can see by where the volume weighted average price is that even though it looks like we started trending up, we broke back over and started trading below the volume weighted average price. So I want you to think about what that means. For a move higher, we start trading below where the average of all the volume in the move higher is. Okay, so that to me indicates that the trend has sort of petered out and is no longer trending, but instead beginning to consolidate. Now that fact is confirmed when we then trade up and are unable to penetrate the prior volume. So let's take another view of this. I'm going to move this profile off, and I want to take a decision point profile and stick it up here where this transition was. So we have buyers transitioning up and moving over to sellers. Okay, so we can see where most of the volume is here. It's up at the top. There is a spike down here. What happens when we trade back up? The high of the move back up gets held up right at where the bulk of volume is. Right. So maybe just to simplify it, let's move it over like this. You can see. Then again, as we come back up, the buyers try to buy through this, and they're unable to do so, and they roll back over. So this is really showing us that there's consolidation. There's a high and several shots trying to get through it, and we're unable to do that. So the reason this is important is because as you begin digging into charts with OFA, you're going to find the tool set very effective if you're utilizing it in a logical manner. It's very hard to sit down and write out specific rules for every type of market condition that there is. And I find that the majority of time, I get questions from people that are asking me, well, how do you know where to put a profile on the chart? And a lot of it comes down to trying to follow a very clear, logical path. And so if I am interested in monitoring a trend, and I find that at some point that trend was visibly broken, like it has been here, and the trend is broken because we break through and start trading below the volume weighted average price, then if I also confirm that with the fact that we're struggling to trade back through the high, it's very clear that in the short term, this is not a trend that we're actually consolidating. And I can eliminate the trend tool set from this segment of the chart. Remember, the beautiful thing about OFA is that we're not relying on indicators that have some sort of fixed look back. I'm not looking at the last 7 periods. I'm not looking at the last 14 periods. I'm able to look at a chart and say, here is an event. We began a trend, we started trending up, and the trend failed, and we rolled into consolidation. Has nothing to do with the last 7 periods or 14 periods. I have to look for where the volume transitioned from sellers to buyers and began an event higher. Okay, and that's what's really important about this process. So once we have kind of the base concept of what's going on in the current, let's take a look back at some of the other things that have happened. So we had a high here and we had a low here. If we're consolidating in a range, it's very likely that we might trade to one of these 2 points. The 2 key transitions of the day are always going to be the high and the low, particularly when we have something that comes in at a significant time of the market, and this comes in at 2 a.m., so right when the London markets are opening up and beginning to trade. So it'd be kind of like the equivalent of having an open for the U.S. Open. If we have key volume that comes in at 9:30 in the morning, or 8:30 in the morning Central Time, or right on the top of the hour, right after the market is open. That's when we're going to look for key decision point transitions, and we've had several lessons about decision points. So this becomes a decision point up at the top. So we have an area of resistance up here that we can mark off, and we expect that there would be resistance at this area, and if we were to trade it specifically, we would be looking to trade it right in front of the point of control. Okay, so by putting that on the chart, we're committing to the fact that if we happen to trade up there and we are not in a position, that is where we're likely to be looking for a short. Now the opposite would be true on the bottom, so we can come down to this and we see a double distribution. It's not as clean as this nice normal distribution of volume up here. There's a double distribution. We could probably assume that it might hold in front of the volume rather than at the point of control. This would be a harder position to trade, but it's right now we're going to consider this to be our lower support zone. And so I'm just going to pull that over and kind of get that out of the way. And that gives us a strategy for the morning. So we could look at any move up to the top as having a very good spread that we might want to capture. And if we're not in a position when we get up here, we want to look at this as a short. To the downside, we don't have that much room here to trade down to the low, and we know that this could be a tricky buy. So we might want to look at this as though, well, the market has been moving lower. Perhaps we come down here, challenge the low. If we don't get a double bottom that we could trade off of, maybe we have a breakdown and it actually breaks through this, and we could look for a breakdown trade rather than a double bottom. I don't think we want to trade this as a decision point just simply because it's going to have a larger stop. We would need to trade it out in front of the volume cluster rather than at the point of control, because there are two individual distributions of volume. That gives us a strategy for the morning, and that's what's really important. We need to start every day with an idea of what we think the market is going to do. Where's the market trying to go, and how good of a job is it doing getting there? That's what our tool set is for. So with that, we know that we are currently in a bit of consolidation. We're having trouble breaking out of the top, and we don't seem to be coming down to the bottom. So we'll see what happens as we walk the market forward here. But we really want to focus on, because this is replay, so we know that there's going to be a trend trade. I want you to focus on what it is that identifies that trend. So I'm going to walk this forward slowly. We're going to go. I need to get this line off of here for now. It's going to keep pushing the chart the wrong way. We'll get back to it in just a minute. So here's the market walking forward. We start approaching the same high again. Now we're at the same high. We're through the prior efforts. We really haven't seen any evidence of a breakout though until we get here. And now what was consolidation, it very much looks like it's beginning to trend. And so when we recognize that we are trending up out of an area of consolidation, and not to mention this is just before the U.S. equity open, this is where we want to start monitoring it for a trend. Why? Because we have a lot of room. We have a lot of room to get up to our target for the high, right? So if this is a trend breakout and we start trending back up, we have a lot of space to capture. So it's a great opportunity for us to look at an uptrend, and it certainly looks at this point as though we're beginning an uptrend. Why? Because we've broken consolidation that we've been in for the last hour, right? So 3 shots to get through this, we couldn't do it, and now we are. So we want to look at it as though it's a potential trend. So with that, I'm going to grab my trend tool, or what we call a swing profile. So I'm going to come over here and I want to grab an active one because I want to be able to trade off of it. So I'm going to come and I'm going to place this on the chart. Now, big question is, why did I pick the place that I picked? That's what most people struggle with. Okay, well, I have to look at the volume and I have to figure out a point at which this move higher began. And if I want to do that in simple terms, I can kind of look for the lowest low in that move. Okay, so in this case, these two periods have the same low. but the volume is basically at the exact same place. This was a push. The buyers were trying to get the market off the ground. The sellers came back in, and the buyers pushed back up. So there's a transition from buyer to seller back to buyer, where the buyer finally was able to follow through. They have the same low. If this period had a lower low, I would start it there. It's just a rule of thumb. I'm looking for the swing to be the event, and so I'm trying to find the first place that volume should be accompanied in the overall profile. And because the volume is in the exact same place, nobody unwinded from this move higher, nobody unwinded from this move lower. It wasn't until we moved up that anybody that was on the wrong side of a trade here would have been stopped out. So once the market starts to move up, I want to go and look for a logical place to begin my profile from. And if I can do that, I don't have to have some fixed stupid rule that says, well, I need to use the very first period. You need to do what makes sense. And the only way that you're going to get a grip on that is to practice it. You're going to have to go through examples. You're going to have to make a decision, and you're going to have to see whether or not you picked the right point. And you're going to learn from that. But like most things in trading, there is not an A plus B equals C solution to it. It really becomes understanding what you're trying to accomplish. And in this case, I'm trying to encompass all of the volume that is part of the event that I'm tracking. And that event is defined here. Now, why is it defined here and not here or here? Because we've already seen that the swing up here was countered. It was countered through the volume weighted average price. I wouldn't start here because this is not a swing higher. This is just a move back into a high. It's not until here that we begin a solid directional move in one direction without crossing the volume weighted average price, breaking out of the consolidation. So this is my event that I want to start tracking, not any other place on the chart. And I'm sorry to spend so much time on that, but that seems to be the number one question that I get more than anything else. Now that we've begun presumably a swing higher, my focus should be on 2 points. The CWAP, which is this blue line, and I'm going to go in and I'm just going to make that a little bit brighter so that it stands out. There we go. I'm going to focus on the CWAP and the VWAP. The CWAP is the cluster weighted average price. It's a proprietary indicator to OFA. What we do is rather than using all of the volume in the swing, we focus on the volume within the actual clusters of trade. So in this case, we're looking at mostly points of control, but each period has a volume cluster, and that volume cluster is in the calculation for the CWAP. The other volume, the lighter volume in the periods, is excluded. What that does is it gives us a leading indicator in front of the volume weighted average price. The VWAP is all of the volume that's contained in this, and that's always going to be our most important line in the sand for a stop. If we are in an uptrend, we should continue to print volume above the average, meaning buyers are averaging in at higher prices, not at lower prices. If we start trading below the average on an upswing, it indicates that sellers are adding into the average below the average, right? So they're trading at ever lower prices. That's an important concept to grasp, right? Because it's basically telling us that this line should be the end of the road. Now, every contract will be a little bit different. Some of them will move right back to the VWAP. Some will trade a little bit through. Some will trade a little bit in front of it. But this is an average, right? So averages are never going to be rock solid numbers, but it's a perfect line in the sand for any sort of long position that we want. So if we take the leading indicator, which is our CWAP, we can presumably buy at this level and use this level as a stop. Okay? That's going to be our strategy here. And so as I walk this forward, I want you to take a look at what happens. The market is holding against the CWAP, and it starts to break away a little bit, and the VWAP is always going to be below that in an uptrend. So as we walk forward, we see the market start to come back down towards the CWAP. Now in this case, it didn't hit it, and I don't like to present situations to you that only happen in the blink of an eye. So let's walk this forward. But the general idea is that we want to be buying at the CWAP or even a tick in front of it, and we want to use the volume weighted average price as our stop. So as we walk forward, you can see we tap the CWAP here. This is a bit misleading because in real time, it really didn't come together this way. The CWAP didn't lift up until this new cluster was moved all the way up here. Obviously, it's an average, so having that volume way up there, this wouldn't have been a realistic trade, and so I didn't want to present this as the entry. But you can see how we're finding support at the CWAP as we break away in a trend. So the idea is, how do we get an order out there where we're capturing this CWAP, VWAP spread? Well, if we set it up in our algo, we can tell AlgoX to send an order to the CWAP. We can even offset it if we want to. So if you wanted to send it a tick in front of it or right at it, you can change it. We're telling it that we want to execute off of the volume weighted average price. Okay? That means our initial stop has to go to the VWAP, and this particular algo that I've built sends it one tick behind. So if I send an order right now, you're going to see my order going in at the CWAP, my stop order going in one tick behind the VWAP. Now, I'm always going to manage this off of the VWAP. Anytime I'm in a trend, I need to have the VWAP as my trailing stop. It's very important that I think that way because that is the line in the sand. Now, I always have the capacity to go and move my stop. If I want to improve it, I can change where my stop is and put less risk on the table after the trade is taken off. But if I'm working on a trend, it's very important that I know where the volume weighted average price is. That's where my stop needs to be. So let's just, as an example, let's say that this spread was massive. Let's say that it was 25 ticks. And I've decided there's no way I'm taking a trade that's 25 ticks. Well, I can either set up the algo to where it will not send a trade that is above a certain number of ticks, or I can just think of it in terms of, well, then where am I willing to get into the trade? So most people think very singularly on the idea that, well, I'm going to trade with a 6-tick stop or an 8-tick stop or a 10-tick stop or something like that. Very few people in the retail trading space are forward thinking enough to say, I need to know where my stop should be, right? Because if I just used a 5-tick stop from here, I'm not using the VWAP. So is the entry more important or is the stop more important? In my book, knowing where the trade is no longer valid is much more valuable to me than where should I get into the trade, right? So if I can only afford to trade a 4-tick stop, that doesn't mean that my stop should be 4 ticks behind the entry. It means my entry should be 4 ticks in front of the stop. That would be a much more logical approach, and that's one of the failing points of most retail traders, is that they get it in their mind that some system or back test or something exists that has some perfect stop value, and they only need to find the entry. And my challenge to you is you need to find the stop, not the entry. The entry is just how much you can risk in front of it and make sense of. So in this case, we have a 1, 2, 3, 4, 5, 6, 7, 8 tick risk. And if that trade's not filled, this risk may increase. And I may determine that this isn't working for me. The risk is too big. Perhaps what I should be doing is using a value behind the CWAP and just hoping that I get filled so that I can encompass that smaller stop. Hopefully that makes sense. So as we walk this forward, we're going to see that the market is going to break away from this CWAP value, and we're going to start moving up and away from it. Now note the time. This is about 8:30 in the morning, so this is the U.S. equity open. So we would expect more volume. If this trend was going to fail, this is probably when it was going to happen. But instead, the market broke away, and then we start to see the market potentially rolling back over. This is a great time for us to be focused on getting our orders out there. And so if we send the order here, we've got an order at 70.30. We've got a stop at 69.95. And if the market ticks forward, we don't get filled there. Okay, so there's no fill on it. Now our order is at 70.30 with a 7,000 for a stop. Okay, and so if we walk this forward, there is our fill. Okay, so we had an opportunity here. I didn't want to make it seem like it was an impossible feat. Now we have another opportunity as the market pulls back into it. What you should be getting out of this is seeing how incredible the support provided by this leading indicator is. Okay, So our orders go out. We have an order here at a 2-to-1 multiple. So this is a 6-tick risk. We have a 12-tick target. Then we have a 3-to-1 target, a 4-to-1 target, and a 5-to-1 target. Well, we know that if this is indeed a trend, we had already isolated where we think the market's going to trade to, right? Our expectation is that we trade all the way up to this other point of control. And the way that it looks right now, all of our targets are just sort of stacked up right here. Well, it's very important that you're making a multiple on your risk. So I don't ever want you to not have a direct multiple of some sort. You can always increase it if you want to get more out of it, but you must be making at least 2-to-1 on your trades, if not 3-to-1 or better. So it's very important that you have some orders out there to sort of take care of this for you. Okay, so in this case, we're taking half of the position off at 2-to-1, half of the remaining at 3-to-1, half of the remaining, or a rounded factor thereof, of it at 4-to-1, and at 5-to-1, we're taking the rest of the position. Now, because we have an actual target here, that sort of profit strategy makes sense. If we were trading into new highs and we were in a trend, we might not want to have a final target where we're taking the remaining position off. We may just want to use a trailing stop. But for this particular example, we have a very clear target up at the top. We just need to figure out exactly where that should be. So our point of control comes in at 72.60. Let's assume for a moment that we're not in a trade. If I was not in a trade and we traded up to a decision point, I would be looking to short that. That's what decision points are for. It's a very low risk trade that has a high potential for reward very quickly. That's the kind of trade I want to take every single day if I can. But I'm in a position. So it doesn't make sense that I would be looking for a short right now. Instead, I should be looking for a target. And so if I would approach this as though it was going to be a short, I would be trading it one tick in front at 72.55. That's where my entry would be, and I would have a stop on the other side of the volume distribution at 72.80. So it makes perfect sense that if this is where I was going to get into a trade, that's where I ought to look at taking a target. So 72.55, I can drag this target up to, and then I can play with the rest of these if I want to. Right? If I have a clear target, it might make sense for me to move it around. So an example would be if I were to go over here and look at this transition. Okay, well, I can see that there's a double distribution of volume here, but this is really the main distribution, and if you just isolate this one, it is a normal distribution. That's coming in at 71.75. So I might want to move my 4-to-1 target up and get a little bit more out of my 4-to-1 target rather than just have a fixed target like this. So these are the types of decisions that you can make as a trader who understands the structure of the chart. If you don't, and you're just following indicators, buy here, sell here, you're never going to get this much depth out of the market. You're never going to understand these things. And that's what's so critical about the OFA philosophy more than anything else. Right? Our philosophy is that you can read the chart and you can get it to the tick if you understand what took place. If that isn't your game and you just want an automated system that says buy here and sell here and buy here and sell here and buy, good luck with it, but this would not be for you, because this is for somebody who wants to do the analytical work. They want the accomplishment of knowing where the market should stop, should pause, should hold, should transition. They want that empowerment so that they have a real career in this and not just the hopes that some programmer is going to come up with something for them, on a monthly basis. So that's the game plan. So let's start walking this forward and take a look at the actual trade and how the market reacts to this CWAP level. I'm going to take the crosshair off so that this doesn't just drive you crazy in the playback. All right, so we dip back down, we hit the CWAP again and lift back up, still not to our 2-to-1 target. We dip back down, hit the CWAP again, don't quite lift up to our 2-to-1 target. We dip back down and hold support again, and again, and we hit our 2-to-1 target. Now, I want you to absorb this. Look how well this is acting as support. When you see this happening, and let me be very clear, it's not always going to hold and be perfect. If it I certainly wouldn't offer it to the public. I would be sitting in a hammock drinking cold beers and on a nice beach in the South Pacific. But the idea here is that when you see something that is holding, it also gives you confidence in that, right? We see it holding. We know that even if I didn't get into the trade here, we're clearly in a trend that is following the leading indicator. We have 1, 2, 3, 4, 5, 6 levels of support just in this move that have had no more than a tick or two through it. So it's a powerful way to look at the market. Let's continue higher. Oh, there's another one. And then we finally start breaking away. So we take out our 3-to-1 target. That leaves our 4-to-1 target up here. And of course, we have a 5-to-1 target a little bit higher as well. So the question is, do we want to leave our target here, or do we want to be strategic about it now that we've put money in the bank? Are we more interested in trying to capture a better target, or are we just going to let it run? I'm not going to presume that we are somehow making vast amounts of money or anything like that. So I'm just going to leave it where it is. But you can see that it would certainly make sense to move this higher. Now, the big question is, if you had missed this trade, or if you got so excited about the jump up, you didn't want to risk anything, and so you moved your stop up really close because you had to protect your profit, and I know how it goes, right? I've been doing this a long time. If for some reason you took yourself out of this trade here, given what you've seen with the market breaking away, pulling back to the CWAP, breaking away, pulling back to the CWAP, would you have the confidence to take this trade again? Or if you missed it, take it for the first time? The simple answer should be yes, and it shouldn't be any different. So if you were taken out of the trade or missed the trade, the idea that you can see, let's just zoom in on this for a second. I want you to note where the CWAP is in relationship to the point of control and all of the volume that we just broke away from. This seems like a pretty damn good place for there to be support if we were to come back to it. So taking the two pieces of information, actually 3 pieces of information together, and seeing not only is there a magical line on the chart, but it's all lining up with other things that I know the market should hold if we trade back against, and I know where the line in the sand is. You shouldn't have any question as to whether or not you would take this again. So as we walk this forward and the market comes back down, we come back down within a tick of the point of control, right into all of the volume where we transitioned out, and right into the CWAP. Not sure why our stop jumped, but it could just be the replay. So stop behind the volume weighted average price. We walk forward. The market lifts up, so we find support at the CWAP again. And we lift back up to the prior highs. So support 1, 2, 3, 4, 5, 6, 7, 8 times at least. So we trade up, we hit our 4-to-1. That means the only thing that we have left now is our target up above. And notice that we're starting to really break out of new highs again. So if we look back at what's taken place here, we can see that the only time we've really penetrated the CWAP, it was only by a few ticks, right? So if we wanted to take the step of improving our stop a little bit, we could actually use the CWAP as a trailing stop. Now, it wouldn't make sense for us to go right to it because we've seen that we can penetrate it by a couple of ticks. But if you're anxious to get your stop moved up a little bit, you can always move it to the CWAP, and I would just offset it by 3 or 4 ticks. So if we move our stop now, we've improved our stop a little bit. We're no longer 100% dependent on the VWAP. We're still behind the point of control. So we're giving the trade room to work because we have a higher target here. Pull the chart down a little bit so we can see that. Because we have a higher target. But this is a personal decision, right? It doesn't. You certainly don't have to improve your stop. If you're looking for a large swing in the market, you want to be using the volume weighted average price. Now, after the market has a large expansion, it's very likely that we have what's called a mean reversion, where we would trade back to the volume weighted average price. So At some point, the market will stop trending and move back. And the question is, how are you going to protect your profit along the way? And so this is just one method that you could use to improve your stop a little bit as we continue walking the chart forward. Here's the market breaking up again, and you can see our stop continues to move with that CWAP just upticking along with it. We could also isolate points on the chart that we think the market shouldn't trade back through. So let's say we wanted to use a decision point here and say this was the prior high and we broke through it. We shouldn't trade back through this level. We could move our stop up there manually if we wanted to. I prefer to just let everything kind of go and make those decisions. If we get really close to it and don't do it, do I want to move my stop up? But so far, the CWAP has been such a powerful force, I don't see any reason not to use that as my trailing stop and just kind of get behind it. So here we are approaching our target. Now again, why is this our target? It's our target because this would be our decision point for the day. If I was not in a position, I would be looking for a short here. And that's an important thing to put in perspective. Think about it. What would I do if I were long? What would I do if I were short? What would I do if I were flat? And if you can make that call, just imagine if we weren't in a position, we would have just gotten short with a stop up above this volume distribution, right? And of course, the market plays and bounces right off of it. So if you would take it as a short, you should be thinking about it as a target for a long. So just to recap the trade, the idea here is that you are able to recognize that we break out of consolidation and begin trending. When you see that, you want to apply a swing profile because you're looking for a trend continuation opportunity, particularly when we have either no targets up above or a target a long way away. You would have recognized that this was a trend the minute that we broke out of consolidation, so you might have recognized it here. But even if you didn't, there were more opportunities for the market to come back and hold support at the CWAP before expanding up to our target. I hope this has been a good lesson for you. If you're interested in trying out the MotiveWave platform, please click on the link on the page and we'll get you set up with a trial.